Welcome everyone to another exciting episode of CRE Exchange. I'm Cole Perry, your host and Senior Market Analyst at Altus Group, a leading provider of asset and fund intelligence. I'm joined by Omar Eltorai, our U.S. Director of Research, and together we'll share the latest news and trends in the U.S. commercial real estate market. Omar, it's great to be with you. Looks like we got a lot to cover on the podcast today. What's on today's agenda?
Yeah, so we're going to start off covering some recent notable news stories, including Powell's testimony on Capitol Hill and SEC climate disclosure walkback, as well as we're going to then go into some of the macro economic data releases. I know that you want to touch on employment and construction data, as well as likely cover the Beige Book and the most recent FDIC quarterly banking profile. And then finally, we'll close the call out with touching on what's happening in capital markets, including what's happening in the banking sector, as well as a number of notable large retailer earnings calls. So how about we jump right in? It's, as you mentioned, a full agenda. Cole, what stories got your attention over the last couple of weeks?
Yeah, I think a lot of people were watching Jay Powell's testimony on Capitol Hill. So the Fed chairman does this twice a year, meets with lawmakers and testifies. And this one was very closely watched because we're coming up on the Fed's rate decision in about a week and a half. But among other things, he also talks about other monetary policy not related to interest rate cuts. But on that subject, Jay Powell did say that the Fed is not far from gaining the confidence needed to begin cutting interest rates, widely signaled that the first could come in June, said that the Fed can and will lower rates this year. He was careful to state that progress towards 2% inflation is not assured, but inflation has subsided without a lot of negative impact, or really any negative impact thus far, to employment. However, his appearance was probably less about this. This is kind of more of the same commentary from him. We'll have to wait for more for the 20th. But he also discussed Basel III Endgame. So this is the proposed regulatory capital changes, or the requirements for banks. So he indicated to lawmakers that significant changes are coming, if not a full rewrite of those rules. After reviewing comments from various industry groups, I think there was quite interesting statements made about the proposal. They warned that, I think the quote from the Mortgage Bankers Association was that it could effectively end bank lending to commercial real estate if implemented as currently written. Don't know if that's too much of an exaggeration, but I think the Fed has taken that under consideration. I'd expect to see a new proposal here in just a little bit. But really interesting testimony. I would encourage people to check that out. Some interesting commentary on different monetary policy. What were you seeing this week? What was kind of the big story that you had to focus on?
Yeah, so going with the same theme of walking back initial regulatory responses, I think something that was quite notable was the SEC's release of the final rule of for climate disclosures for public companies. This really comes after nearly 2 years since this rule was introduced. And I think I saw that there were over 24,000 responses and comment letters that came in. So it was, the climate might be hot, but like this was definitely a hot topic as well, right? And there's a joke somewhere in there. Maybe didn't stick the landing on that one, but but ultimately with this final rule, I think the most notable thing is that the Scope 3 emissions were really eliminated. So Scope 1 emissions really being what are directly created by the activities of the companies. Scope 2 really being, the emissions that are contributed, even if they're a little bit involuntary and more focused on the process. And then Scope 3 is what is indirectly contributed within the value chain by the company. And that's, I think Scope 3 really is the most kind of like contentious in terms of, how do you measure it? And, it's, even if you're as a company are contributing to it, it's always indirect, and so it's tough to really manage, tough to measure, tough to kind of like influence. But even now that you know what Scope 3 is, really, you can now get that kind of like out of your mind, because that didn't make it into the final rule. Prior to the final rule, really many companies have been voluntarily sharing some climate-related metrics and goals, but with the passage of this rule, and it means that public companies are going to have to start sharing way more and in a much more standardized reporting reporting process. And so what this means for commercial real estate, well, it relates to commercial real estate in a few ways. First, and most likely, the ones that are going to feel the most significant and immediate impact are really the publicly traded real estate companies. So you can think of either real estate operators or REITs, and these companies are going to have to share their net zero plans. Hopefully they've already started working on putting them together, but if they haven't, then they really got to get going on that. But then otherwise, they'll likely be sharing these with the broader market and with the regulators by 2026. And second, given that this affects all public companies and it's not just like public real estate companies, there's going to be an expectation that the tenants or that are public companies are going to have to start capturing more of their data. So this means that they're going to be going to their the building owners where they occupy space and effectively be asking for the metrics that they need to consider in their own net zero plans. So you can think of electricity. You can think of pretty much just all power usage. That's going to you can anticipate the public companies that are affected by this final rule to essentially be starting to really ramp up gathering their information, and that will likely impact the property owners. And then the third way that I could see this really kind of like affecting the commercial real estate industry is it has to come down to the reaction of the market, collective kind of like market reaction in the market for this space, right? So if if companies have to make commitments to decreasing their emissions, and if they're making commitments that are dependent on tracking their emissions, well, then that gives a bit favorable, I would say there's a favorable characteristic for owners and operators, as well as the buildings that have lower emissions, that track their emissions well, and can be able to provide this information and kind of fit into that end goal or to that lower emission planning process. And so while that is, I think, significant, it's not, or it just became more significant, I'm still having a tough time understanding how significant that really will be. I know that, properties can trade at premiums if they have, if they're more up to date, if they're energy efficient, but understanding the full impact on not only the performance of the building, but then ultimately on the valuation, I think that is still TBD with these rules. And so that's, I think that might have missed a number of folks' radar, but thought I would raise it here. Definitely it's something that I think is worth paying attention to. But now shifting attention over to recent data releases. Cole, I know that you were looking at some labor data. What did you see there?
Yeah, before I jump right into that, I did want to say, I'm not too surprised to see that Scope 3 walked back. There were some stories out of California of similar rules, and you get into that question of tenancy, and there's almost no limit to how far down the value chain you have to track information. So I'm really not surprised to see that walked back. But thanks for looking at that for us. I was looking at a lot of employment data this week. So, why do we do this? One, it gives us an overall view of the health of the economy. This is one of the most closely watched pieces of data for the Federal Reserve, so feeding into their interest rate calculation. But it's also an indirect indicator or direct indicator of demand for CRE space, notably for office, but probably also for multifamily and for retail as well. But we got the February job openings and labor turnover survey in addition to the employment situation. So both of these from the Bureau of Labor Statistics. They released the January data for JOLTS on March 6th, showing virtually no change on the month. There were 8.9 million job openings, 5.3 million separations. And despite being flat on the month, these are actually down 17% on the year and well below their March 2022 high of 12.2 million openings. Total separations, which are inclusive of quits and layoffs, were down 11.2% on the year. But I will say that economists are really closely watching that level of quits. More people staying in their current roles and the sort of quote great resignation being over is definitely a signal that the economy or the labor market in particular is softening. A couple of nuggets in that data that were really interesting. So the largest increase in job openings came from non-durable goods manufacturing. So a lot of those facilities that we've been talking about that have finally come online for domestic manufacturing. The largest decrease for openings was in private education. This was quite interesting. I've seen a couple of stories recently about distress, particularly in the small private college sector. So couple that with the release of the employment situation. I think the JOLTS data does paint a picture of a stabilizing job market. Federal Reserve is definitely going to consider these when assessing their, the pace and timing of interest rate cuts. Some other nuggets from that employment situation summary. Payrolls rose 275,000 month on month. This was much higher than economists' expectations. But I think what a lot of people focused on was that we saw a slight tick up in unemployment, up to 3.9%. So BLS actually made a revision to the December and January payroll gains, slashing about 167,000 jobs. So those two pieces of data together, I think, were focused on quite a bit in the media. So I think these suggest a weaker, albeit we'll call it a normalizing labor market, though the report overall has not changed expectations about the Federal Reserve's intent to cut interest rates. The economy does remain strong, and I think it was worth noting that February did mark the highest unemployment rate since January of 2022, but it also marked the longest period of sub 4% unemployment since the 1960s. So might seem bad on the surface, but I think the economy is still quite strong. You can see the Fed's hesitation to cut interest rates in an environment like this. I know that wasn't the biggest data release, certainly one that the Fed was looking out for this week, but one of the things that comes out on an irregular basis is the Federal Reserve's Beige Book. We've talked about it on the podcast before. What were some interesting nuggets from there?
Yeah, so on March 6th, the Federal Reserve released the Beige Book, which really covers qualitative findings and anecdotal nuggets of information on the current economic conditions across the Federal Reserve's 12 districts. And I really enjoy this piece and this report just because so much of the data that we're looking at is, it's just hard. It's hard numbers that you then have to go and understand what is it looking at, where is it, what is it including, what is it not including, and making sense of that, which I think that's great. But then here's a regular piece that comes out that is very much qualitative in nature, and it's talking about that they spoke to a contact who said X. However, another contact disagrees. So it's one of my favorite pieces just to pair with the hard data to really make sense of what's going on. And in this most recent Beige Book, the there were some high-level themes that came out, as well as, because this is a CRE podcast, we'll dive into the CRE meat. But at the high level, it was slightly improved, I would say, economic conditions since the start of the year. Overall, I'd say it was kind of, flat-ish, but slightly improved in some areas. And there was one district that did report kind of like softer level of overall economic activity compared to January, but overall I'd say that we were in a pretty good spot in this report. And across many of the reporting districts, there were a number of themes that came out as being shared and across the nation, but one that really stuck out to me was kind of a cooling consumer, right? So this either came out in comments around pricing and how businesses who are ultimately selling into the U.S. consumer base were having a tough time passing on those price increases. So that means the consumer's getting more and more sensitive to any continued inflation. But then also that there was some pullback by consumers in certain spending areas that I would say are largely discretionary, right? With the exception of airlines, really you were seeing some softening in consumer activity across retailers, as well as food and beverage was often mentioned. And so I think that context is very helpful to better understand what people are seeing, right? What people are hearing, and where it's happening across the country. But then the report also does highlight a number of key commercial real estate themes across the districts as well. And so I'll call a few of those out. First is that commercial real estate activity has generally been, weak, right? However, this is, if you're looking at and you read the Beige Books, as they come out, I would say that this is a comment that has been there for, many months and many Beige Books. And so ultimately, I didn't see too much change here. There still are quite a few comments around office, right? And a lot of concern around office, as well as it's just overall weaker pricing, less construction, overall, very little transactions. And if there are extra comments around office, it's usually around valuation or negative performance. Also at the high level, I would say for commercial real estate, we've seen over the last couple of Beige Books quite a bit of commentary on the financing side, right? So tighter loan underwriting, decreased demand. Part of that is due to interest rates being higher. And that was there as well. However, we did get a number of new comments that really caught my eye. The Kansas City Fed, they tend to write more on commercial real estate than the other districts, and I'm a huge fan of their commentary. One thing that they highlight is that there's increased skepticism around recent appraisals and the property valuations. And there was they use a quote of that participants in the market don't want to be in a position of trying to catch a falling knife, right? And so there's concern that because the valuations are not properly reflecting the market conditions, that there's further write-downs and that further valuation changes to come, which is preventing a number of would-be buyers from getting involved in, at least in the Kansas City district area. Another, I would think, noteworthy mention came from, or was focused on office, right? And office again has been mentioned in many Beige Books before. It's I'd say CRE sector that everybody loves to hate, and while it was also mentioned across many districts, the there was one comment that came out that from the Dallas Fed, which I thought was interesting. They noted that tenants or would-be tenants for office space were starting to do background searches and credit checks on the owners of the office space, which usually, maybe companies do that often, but this is the first time I've heard of kind of this reverse, credit check, looking at the owners to make sure that those owners are still going to be around for those, I guess if you sign a 5-year lease. And then also popping up into many of the comments from the different districts was the topic of insurance, and St. Louis Fed as well as Atlanta Fed both had comments around this. They noted that the higher insurance costs have really made it difficult for multifamily owners to kind of like pass these rates on, as well as there was a comment around how it has been disruptive for construction as well. And finally, I would say that while there's really no clear sign of significant CRE deterioration, whether it's on the financing side or on the kind of the property operations and performance side, the outlooks that were noted in the most recent Beige Book were still showing signs of concern about the asset class, about commercial real estate, because there is uncertainty around the economy. There's a lot of acknowledgement of interest rates and the sensitivity to interest rates, as well as just I would say other factors that ultimately weigh on the outlook for commercial real estate. And I would say, while it hasn't deteriorated, it still hasn't necessarily brightened significantly. And so I know that the Beige Book, it does call out quite a bit of construction delays across the districts, but these were qualitative in nature. Cole, I know that you were looking at some of the hard numbers for construction. What do you have to share there?
Yeah, well, I always love hearing those qualitative sort of anecdotes from across districts. I think the Dallas one's particularly interesting to me because a lot of CRE finance professionals are there now too, so you get a lot of interesting commentary from Dallas. But we did get some hard data from the census on March 1st, so almost a couple of weeks ago, but this is presented in a seasonally adjusted annual number. So they do the value of construction put in place. They use a significant number of other data sources to kind of back into these figures. But the value of the private construction pipeline did remain unchanged in January 2024. So that was a little bit of a surprise. I'd seen this slow, but for it to be virtually unchanged was a bit of a surprise. It came in at 1.62 trillion for the total private construction pipeline, but specifically private spending on non-residential construction, so manufacturing, commercial, office, healthcare, and lodging. Commercial, I think, inclusive of both like warehouse and retail. That also remained flat month over month at 500 billion. So I think we have some decent evidence here, though just 1 month, that the pipeline is slimming or may begin to. So the pace of growth in construction in the manufacturing sector is really slowing. This was up 36.6% year on year, but that was after 60% plus growth all of 2023. So a lot of slowdown there, probably something that a lot of those Fed districts were noticing. So the rate's been slowing. January data did shed some light on the cooling trend that I think we've been seeing for a little while. But that was probably not the most watched out for piece of data. Another big report came out. I know you and I kept refreshing our browsers each day for this one. The Federal Deposit Insurance Corporation's quarterly banking profile, which gives us a little bit of an idea of financing for all this stuff. What did you see there? Give us the rundown. I know we've been waiting for this one for a long time.
Yeah, certainly. So, as the name implies, the quarterly banking profile is a quarterly set of data that really is aggregating all of the FDIC insured banks. It aggregates their balance sheet, looks at loan performance, and allows somebody to slice and dice really and understand kind of like the banking system as a whole. And so this is something that was eagerly anticipating and diving into, because this is I think for reminders of listeners who don't remember or need to be refreshed, banking is the single largest segment of capital for commercial real estate. And it is hugely important for financing everything from construction activity to transactions to also financing the operators and the owners, even if not just the assets. So understanding what's happening in the banking system, I think, is hugely important for understanding the speed and the direction in which not only the economy but very much commercial real estate is going. And looking at the quarterly banking profile at a high level, I would say there is a kind of at the highest level, there is positive takeaway that we ended the year kind of better than we started, in the sense that if you recall, in the first quarter of 2023, there was a bit of a banking panic as SVB and First Republic, were two of the, I would say, like victims or kind of the market conditions. And everybody learned a valuable lesson in terms of interest rate risk management. So while there was some stabilization there, we also saw and you saw that in the form of overall deposits, deposit growth kind of normalizing a bit, and the system as a whole was not, it never really broke, and I think that's very much a good sign. Looking at the quarterly banking profile and making some comments on kind of like the banking system as a whole, the deposit base did shrink by 2% on the year, but again, I would say that there was a concern earlier in the year that deposit growth would be significantly less, and actually that if the banking system lost its deposit base, that would be a real problem. So down 2%, that's okay. I'll take that. But then also the loan yields on loans up, the cost of deposits up, which cost of deposits moved up higher than the yield on loans, which ultimately means that puts kind of a profitability squeeze on banks, because if they have to pay more on their deposit base than what they're getting paid on their loans, then that really shrinks their net interest margins. Reserves also increased, and this is where commercial real estate comes into the fold here. Reserves are set aside for potential and expected losses. And so as the reserves increase, that means that banks usually are preparing for increased losses, which that is, the fact that they do set aside reserves, I would say, is a positive, because that's you don't want any. When you have losses that exceed your reserves, that's when it really becomes problematic. But many banks are increasing their reserve balances, which is a sign that they are expecting more losses to materialize. Overall asset quality, was pretty healthy for the year. With the exception of, I would say, commercial real estate and consumer credit, which they're starting to show kind of like the most deterioration. As an industry, the non-current rate increased 4 basis points from the prior quarter to 86 basis points. This is for we're going to have to scratch that. My bad. All right, boom, boom, boom. So the portion of past due commercial real estate loans is trending upwards. It has increased by 2.3 billion, or about 13.1% quarter over quarter in the fourth quarter. And this is for the non-owner occupied commercial real estate properties. And it was noted in the quarterly banking profile release that this increase in past due CRE loans was really concentrated at the largest banking institutions. But I'm a little bit skeptical of this, meaning that I don't think that this is a problem that's isolated to large banking institutions. I suspect that it's the large banking institutions that are recognizing it first and are, and taking the hit now, or acknowledging the non-current nature of these loans. But it's something that I very much don't see. I don't see how this can be only concentrated at large lenders, and so it's very much something that I'll be watching for going forward. And the final kind of point on asset quality is that the industry's quarterly net charge-off rate has increased by 14 basis points. Currently sits at 65 basis points, or 0.65%, and it is 17 basis points higher than the pre-pandemic average rate. Again, net charge-offs are not a good sign if net charge-offs are increasing. That's a sign of overall asset quality deterioration, and this is something that again, commercial real estate and consumer are really driving that deterioration.
Yeah, I mean, I think I was looking at some of those numbers. The non-current rate and the charge-off rate definitely a bit concerning, higher than their pre-pandemic average, higher than their pandemic peaks. I think we're a little early in the overall CRE distress cycle. I wonder if you got any inclination about that from the data.
Yeah, absolutely. And one thing that they don't necessarily call attention to, that I think is worth watching because it moves a bit more, is the recovery rate. So when you're looking at what was set aside less the net charge, what was actually charged off, I think it's important to see the difference between that and ultimately find kind of like what was recovered. Granted, this is not a perfect recovery rate because you don't know what expenses went into recovering, but I'm just looking at kind of a relatively crude metric of the amount that was not charged off, right? And these tend to be higher, right? So you tend to have higher recovery rates during better economic times, and when it runs inverse to kind of like the credit cycle. So it's higher when distress is low. And what we've seen recently is that it very much is dropping, right? It's dropping. It's below its historical average on all the segments and subsegments of commercial real estate. So whether you're looking at multifamily, whether you're looking at non-farm, non-residential, and whether that's owner occupied or not, and you're seeing that these recovery rates have plummeted. And to me, that's a real sign that we're not quite out of the woods yet. I do know commercial real estate is being interest rate sensitive, and it is something that I think very much will be impacted by and any sort of rate decisions, but a lot of this is being marked because of performance issues, and performance is not always, it's usually the valuation side that tends to be more rate sensitive. Meanwhile, performance issues, aren't aren't the math isn't as it's not as a direct relationship to interest rates as valuation is. So that's what jumped out. In terms of where we are, I would say we're still early innings in terms of any sort of distress or credit cycle for commercial real estate.
It certainly took until well into 2011, even 2012, before we got sort of peak delinquency, peak net charge-offs for CRE last, during the GFC. So I would agree with you there. But would you say the recovery rates were kind of the big surprise in there for you, or is there anything that jumped out?
Yeah, I mean, I do think that would say is the biggest surprise that hasn't necessarily been covered by other massive media outlets.
Gotcha. And I know you were also taking a look at some kind of quick banking stories. We got some news about New York Community Bank. You want to tell us or give us a rundown of kind of what went down there over the last few weeks?
Sure. So, again, this is, I think, has been very well covered by media outlets. Bank examiner and regulator essentially encouraged the bank to recognize greater distress in their book. Ultimately, that came as a surprise, a shock to investors. And this was really in their the disclosure of their fourth quarter and full year results back in, I think this was January or February. Ultimately, since that announcement, the bank's stock has been under pretty significant pressure from either investors exiting or also a lot of short selling going on, and ultimately that as a bank's stock price drops, it erodes kind of like the equity that is available for the bank, which the equity available factors into a lot of critical calculations and ratios for the bank to keep really operating and kind of be in compliance with its capital requirements. And the big news was last week. You had two former officials really come into the picture when Joseph Audin, who was the former comptroller of the currency, was appointed as a new CEO when the bank received like an equity injection of about $1 billion from an investment firm that was run by the former Treasury Secretary Steven Mnuchin, along with other funds. And so this really not only gave the NYCB a new capital source, but also it really did. I would say like it stabilized at least the company's stock as the market was given confidence over the the new management and new capital being there. And to me, this is it's a fascinating story that I think is still very much playing out, but it is a great highlight of the intersection between banking and commercial real estate, and that even though I think everybody's ready to hopefully turn the page on kind of like higher for longer and get to the next chapter of what banking and commercial real estate look like when interest rates are falling. We're not there yet. There's still kind of a lot of there's still a lot to the story that we're currently living in, and commercial real estate and banking are absolutely interconnected in many ways, and we haven't seen this fully play out yet. So I think a lot to watch. And speaking of watching, I guess Cole, I know you were listening to a number of earnings calls and watching earnings presentations. What did you see there?
Yeah, sticking on the subject sort of the markets, that we're rounding out the rest of earnings season by getting the remaining big retailers. So I remind folks of this on the podcast quite a few times, but these retailer earnings are delayed about a month from the rest of the a bunch of the other big earnings because they include the holiday season. And so why take a look at retailers? Well, I think these are important to track for a couple reasons. Well, for one, they're direct occupiers of real estate. So whether that be their actual storefront or their distribution facilities in various industrial spaces. But also they give a really good signal of the health of the consumer and ultimately the economy. So we got a few this past week. We had Target, Costco, and a couple of discount retailers. Target's call was very interesting. They actually beat on earnings per share. They did see a comparable sales decline, but they ultimately beat forecasts. They had huge growth in their curbside pickup business in 2023. And so that combined for more than, or all their stores combined at the curb for more than 10% of all sales, which I think was worth noting. This is a sort of a newer venture for them that really picked up during the pandemic. The company did announce plans to open more than 300 new full-size stores over the next decade. That is if you follow big retailers, that's a dramatic departure from what I would say was their priority in the 2010s, which was to open up small format urban stores. Now, you and I are both here in New York. We see a ton of them, but I don't know how many more of the small format stores we will see pop up in the 2020s here. But they do plan to open 300 full-size stores, and they'll remodel 2,000 existing stores. Their stock surged on news of their earnings, more than 12 points. So they've outperformed the broader market, and they've also outperformed other retailers, particularly Walmart. So really good year for Target. Should be interesting to see kind of how they fare in a muted consumer environment. I've mentioned this before, but Target, though it doesn't have the same sort of connotation as Walmart does, it is a discount retailer, and so a lot of what otherwise might be consumer distress could end up being a boon for sort of a general merchandise store like Target. Costco actually had their earnings call this week as well. They beat on earnings per share, but they missed on revenue. So Costco is one that I love to track. I would say Costco's model is sort of the envy of the retail world because they charge customers to shop there. So even if a customer never walks through the door, you get a fee out of them every year. So Costco does have strong recurring revenue. They really this year saw higher same-store sales growth than Walmart and Target. Their revenue rose 5.7%, though this was not as high as some analysts expected. Their foot traffic was up quite a bit. However, their stock fell almost 8%, their worst day in more than 2 years. Because they announced they would not increase membership fees, and a lot of institutional investors were expecting that. Raising fees for Costco is sort of a way to get an immediate revenue injection without sort of changing any operational expenses. And so I think analysts and investors were expecting this, but their stock dropped despite Costco having a decent year in 2023. I think it's good to pair this information with sort of the discount retailers. One that I was following this week, and one of the last ones to report is Ross. So Ross easily smashed analysts' expectations. But I would say that something that sort of kept coming up in their call was executives were concerned that since they have a low to middle income customer base, housing cost, gasoline cost, food costs are really eating into the discretionary spend budget for their customers. And so they're very concerned about that. However, doesn't seem to have stopped them for having positive expectations for the next few years. They, in the past, have opened new stores at a pace of 100 per year, and they expect to maintain that for the foreseeable future. So discount retailers, again, could likely be a recipient of some of that consumer pullback. People going from full cost retailers for clothing and apparel to lower cost ones. So really interesting nuggets there in Ross's earnings call. But I think we'll put a pause there for a couple of weeks before we start getting some other earnings calls. But definitely some good nuggets in retail. I did want to point out that next few weeks are going to be loaded with other data releases, so happy to share a calendar of those with you guys. Before this recording hits on Thursday, we will have gotten the NFIB Small Business Optimism Index, along with CPI, PPI, and business inventory data. On Friday the 15th, we will get the University of Michigan's Consumer Sentiment Index. Always like talking about that one. And then the following week, we have a lot of housing data, building permits, housing starts, and existing and new home sales. And then on the 20th is the federal funds rate decision or lack thereof. So we will also get some durable goods order data on the 25th, so probably the same day we record in just a few weeks. But Omar, I know you have an announcement. We should about the industry conditions and sentiment survey.
Sure. So thank you to those who participated. We've been going through and finalizing kind of like the takeaways and analyzing the data so that we can have it in a pretty format to share with you. And we'll be releasing that at the end of this month. So keep an eye out for that. I'm sure we'll bring it up again on the podcast and via the newsletters or articles and reports. So do reach out if you want to receive that. You can shoot us a note, but or sign up to receive it in your inbox as soon as it drops.
Excellent. Well, thank you so much, Omar. I think that's all the time we've got today, and I look forward to speaking with you on another episode of CRE Exchange. Have a good one.